Good morning, everyone, afternoon for some, and evening for others all over the world. Welcome to today's call. Today is, of course, we are focusing on the the $1 million option pattern. And this is specifically for my 98 percenter club. And so if you are new for this on this call, I do want to welcome you. If you're new into the club, I want to welcome you. I do want to give you a couple of quick warnings before we get into today's call, especially if you're new to this pattern, if you're new to this approach. These are some fantastic trades, but you absolutely need to start small. They are a little bit more complex than what a lot of traders are used to. And so you definitely have to make sure that you understand what you're doing. You understand the pitfalls and the traps that exist with all strategies. But certainly there are some pitfalls and traps with this pattern as well. So you want to start small. You don't want to be reckless in how you put the trades together. You want to pay attention to the warnings that I do give on this stuff. And you definitely want to follow the instructions. So as you move forward, as you gain some confidence and understanding of how this works and how the pattern works and how the pattern reacts to different market conditions and whatnot, you might get a little overconfident, and you just have to make sure that you stick with the trading plan. And the reason that you want to stick with the trading plan is because you can grow a relatively small account fairly large, fairly quickly, considering the average weekly gain. So the realistic target for this approach is $40 a week. And if you can average $40 a week, if you can get to where you can average just $40 a week, you're talking about growing a $2,500 account into as much as about as 14,000 within 6 months. So that's a pretty significant growth, considering that the max risk on these trades, if you place them on properly, is about $100. And most of the very, very few instances where you will actually incur a $100 risk on these. So this is something that you don't need to be aggressive with. You don't need to try and make a killing with. We're not trying to make a killing with these. Overall, your average is not going to need to be, you don't need to make a killing based on the overall average necessary to grow your account. So that's over the first 6 months, if you can average $40 over the first 6 months. If you can average that $40 per week for the next 5 years, you're talking about growing the account into 1.8 million, 1.08 million, excuse me. And I'm going to tell you right now that there are ways that you can improve on how you execute this approach, on how you take advantage of it, and you can increase your weekly average gain over the long run. And then things really get interesting. But that is for those who go through the TPO seminar. I talk about all of that stuff in the TPO seminar. So once you get comfortable with this and you have a few profitable trades under your belt, and you have watched it, you see it work, and you see where the traps are, and you understand it, and how to avoid those traps if at all possible. Sometimes it's not possible, but once you get to that point, you're going to want to move on with your education on this, because if you can increase your average weekly gain by just $10, you're talking about a $300,000 to $500,000 increase in the compounded effects over time. So it makes a difference. Also, if you're not averaging $40, don't be discouraged. You'll get there eventually, But even if you only average $20, you're still looking at returns that are far greater than some of the best performing stocks on the planet over the course of 3 to 5 years. So you don't need to do well. Just make sure that you don't go overboard as we go through this process and you start to learn how to take these trades, and you'll be good. So the $1 million option pattern, I'm going to, obviously I cannot explain everything about the pattern in, a single call, but you're going to learn a lot in every single call that we do. And this month has been a little bit slower for me because I was technically on vacation. I did unfortunately do some work, but I was technically on vacation. And so what I did is before I went on this vacation, at the end of July, I went ahead and went 2 weeks out on my MDOP trade. So the $1 million option pattern, you can do it 1 week out, you can do it 2 weeks out. Actually, I did it about 2.5 weeks out. And interestingly enough, it worked out really well with regard to the market moving up, because at the time that I placed on this trade, which is what you see here on the screen, by the time I placed on this trade, the market was trading at 324, and I had placed on a 327. And you can see the order one, that's my bearish. I placed on a 327, 330, 331 call spread. And I did that at a credit of 160. All right, so this screenshot was taken pretty much right after it was filled. And you can see here that the market was trading at around 324.86. So I was actually able to go out of the money it was actually trading a little bit less than 324.86 at the time, but it was almost 3 points out of the money with my first bearish trade. And my bullish trade is order number 2, and that bullish trade was short of 334, short of 336, and then long to 334s. So this is a typical MDO pattern, or a $1 million option pattern. There are different ways of putting these together, and this is one of the ways that I've found has been the most reliable up to this point. So from a standpoint of which patterns we're using, there are actually 4 different TPO bearish patterns, and I actually have 4 different TPO bullish patterns. And you can combine TPO bearish 1 with TPO bullish 1, or TPO bullish 2, TPO bullish 3, TPO bullish 4, et cetera, et cetera. Depends on what you're wanting to achieve, but we're going to keep it simple. We're going to pretty much stick with TPO bearish neutral pattern 1 and add that with TPO bullish pattern 2. And so I know y'all don't have access to the other patterns. It's not necessary. So this is going to be the typical setup. Now, depending on what's going on in the market, the only change that is going to need to be made as we move forward with this pattern, different than the way I put it together today, is something I'm going to talk about in a little bit, and that's the structure of how close the bullish strikes are to the bullish pattern strikes are to the bearish pattern strikes. And generally, as volatility drops, you are going to want to move these strikes closer to the bearish pattern strikes. So the bearish pattern strike is 327, 330, 331. Okay, the highest short strike here is 330. With my bullish, the lowest short strike is 334. So there's a 4-point difference between the highest short strike of the bearish pattern and the lower short strike of the bullish pattern. And the further away that is, the more you're at risk for what is called a dead zone. And we'll get into that as we talk about today's trades, and actually a trade that I took this week as well. So this particular trade, there are several ways to do this, and you can put the order in. Of course, this was taken with a trade partner, and the way I put the order in is I put the order in for the bullish first. And the reason I did that is because the bearish actually will react a little bit quicker with the market movement. And so if the market moves up, the credit on this will actually increase quicker than the bullish price. If the market moves down, the bullish price will actually drop a little bit slower. And so given the market condition, I just decided to do the bullish first, then the bearish, in order to make sure that I got a credit on the trade. And so you can see here I was filled on the bullish, and with the bullish, in this particular example, I was in 10 bullish to 5 bearish. And if you start this, it's going to be 2 bullish to 1 bearish. And that's how it works. So with that, on the bullish being filled, that's 75 a piece, that's 75-cent debit. Right, as I said, execute order 2. And that is order 2 is the bullish. And I said 75-cent debit, and I do a 2-to-1 ratio. So that means that my total debit on my bullish, if I were doing a 1-lot spread, was $1.50. And then the way I set it up in Trade Partner, I said if order 2 is filled, then I'm going to execute order 1. Okay, so hopefully you can see that order 1 right there. And so order 1 was not going to be placed until order 2 was filled, and then I said execute it at $1.60 credit. And so that was filled at $1.60 credit. And shortly thereafter, you could, as you can see here, the bearish was trading at 169, and the bullish was trading at 89. Basically, it was making about $20 within, I don't know, a couple of hours of trading, maybe a little bit less than that. So this can be fairly responsive if the market moves up. And if the market moves down, you're safe. Because as long as the market stays below 327, you are guaranteed to make the total credit on this trade. And the total credit on this trade, again, since my total debit was 150 and my single bearish was a credit of 160, I have a total net credit of $10 on the trade. So no matter what, if the market moved down, I was going to make $10 on this trade. If the market moved higher, then there's a dead zone, and there will always be a dead zone, generally between the short strikes of the bearish and the bullish with this pattern. Now, the closer those strikes are, the lower the risk of that dead zone. But as the market moves higher and volatility begins to drop, you're going to have those closer. And I'll say that many, many times. That's how you play this. As the volatility moves, as the market moves higher and the volatility moves down, you're going to want to constantly look at getting closer strikes with the bullish, as close as it will allow you, while still getting the credit, is essentially what you're going to want to do. But nonetheless, this is the original graph, the projection graph of this trade. And you can see here again, because it has a total credit of $10, no matter what, cannot lose, to the downside. It has a wide profit range. And then the maximum risk to the upside is actually only $100. And of course, the market would have to skyrocket to get there. In order to get to that risk, it has to move through this profit zone. So as the market moves up, the volatility is going to drop, so this whole thing is going to come down a bit. And exactly how much it comes down, there's some educated, you can make an educated guess at how much it's going to come down based on what the value of these longs are, because this whole thing is based on the extrinsic value of the longs that is left over when this trade ends. And in the meantime, hopefully you'll have some opportunity to get out at a $40 profit or $50 profit or wherever you are at on your target with this. This trade hit the minimum target fairly early on. But of course, what the process is you want to go for a bigger target until you get to the point where you're not hitting the target. That way, by that time, you will have watched the trade and you will know whether to trump the target and get out based on a time scenario. So it kind of steps you into that process, because the exiting is actually a little bit more difficult than the entry if you don't have an exit plan. If you just hold on until the very last day, that's generally not, and the very last 10 minutes, that's generally not the best way to play this. But sometimes you don't have a choice. I'm in a trade today where I got stuck. I took it on Monday, and I got stuck to where I was forced to still be in the trade, which I'll disclose here in a minute. And I'm still in the trade because it's trading right at my short strike of my bearish. And they have absolutely slaughtered the value of any long calls on Monday. And I'll mention this from time to time in the calls as well. But the third week of the month generally is the worst week for Monday, the value of Monday options on Friday, I should say. So the lowest value, the overall average, and we've done this, ever since they started weekly options, or ever since they started Monday options, I should say, we've tracked the average. And the third week, so the value, let's say an at the money option on Monday, that expires on Monday, the value of that option at the close on Friday is generally lower the third week of the month than it is the first week, the second week, or the fourth week, and then obviously sometimes the fifth week. So this is one where they have absolutely killed the volatility. And we weren't quite there last week, but because the market had made such a huge move higher, we actually moved past last week before this close. We actually moved past the profit zone here, and there were many, many, many opportunities to take the profit. The biggest target that we have suggested in the 98% report, many, many, many opportunities to take that long before the end of the trade as it was moving through this profitable zone. If you held on until the end, then what happened was we actually saw the market move a little bit past this profitable zone. Of course, the profit zone is based on where the bullish strikes are. These two profit peaks are at the 334 and 336 calls. And that's where you're going to make the most money if you hold on to it until the very last minute. And that's because those the short options will have the least amount of value at that point. If you're at 334, then both of those, the 336 will have no value, 334 will have no value, and then it'll all be based on 4 334 long calls that expire on Monday and whatever the at the money calls are at. And Prior to this particular trade, or at the time that this particular trade, the average was the at-the-money average of a Monday option was between $1.50 and $2 over the past, I'd say 6 or 7 weeks. And just like that, boom, in the last 2 weeks, because the market moves up, and again, if you've watched any of my stuff, you know that this volatility does not hold up. It drops. And so the average Monday option, or excuse me, the at-the-money Monday option last Friday was only trading at $1.27. And this week it'll probably be a little bit lower. Let's see, where's it at right now? So the market's trading just above 338. And Monday's option, the 338 call, is going at for about $1.50 right now. Let me see if that's correct. I believe it is. Yep, about $1.50 right now, $1.55. So they're dropping it. By the end of the day, if we close at 338 even, they will drop that at the money call to probably about $1.20, maybe even $1.15. I mean, they're just killing the volatility. So, which means that the out of the money options will be even less. So, in a worst case scenario, if you're in this bullish, as an example, if you're in this bullish trade, and the 334 and 336 calls are worthless, you've got 4 334 calls, and they're at let's say $1.15 a piece, right? So you're looking at a total spread there of $460, okay, $460, and your max risk on this trade, and again, we were in these at 75 a piece, so that's total of 150. So if you do the math, whoops, if you if you do the math, you're looking at $310 profit. So that's kind of the worst case scenario, in that if you suffer the maximum loss on the bearish, which was significantly less. It was $240 was the max loss on the bearish, so significantly less. So even holding on to the last second, you're looking at a pretty significant profit. Okay, now with this particular trade, if you happen to be stuck, there are several ways to go about this. One of the ways here is to exit the bullish while the market is going through the bullish zone. Now, most of the time, the market's not going to go through this bullish zone if you're in on a shorter term basis. If you're in on a shorter term basis, you're talking about, and it depends, I guess it depends on how close the bearish is at the time. So we're actually get into basically an at the money, and I'd even be willing to get into a slightly in the money bearish with where the market is at right now, which is now at basically hovering right below all-time market highs, and which happened this week, right? So with this, as the market is moving through here, you can go ahead and get rid of your bullish trade, because if the market moves back down, so if this is not the last day, or even if it is the last day, if the market moves back down, you will have captured the maximum profit potential that was available before the value of those bullish start moving back down. And I strongly suggest this, because when the market moves up into this bullish area, if it moves back down, the volatility will have already dropped, and you will start to see this create a dead zone. So with that volatility, and so that's one way to exit. The other way is if it goes the other way, and you're able to exit. So we were in this one for a credit of 160. If we're able to exit for $160 profit, the bearish side, you can go ahead and do that, because no matter what, you cannot lose more than $160 on the bullish. And so if you exit the bearish for $160 gain or something close to that, and then the bullish moves or the market moves back up a little bit, you might be able to pull a little bit out of that bullish trade. And you don't need, if you take a profit on the bearish of, let's say, $160 because the market tanked, you don't need the bullish to get back up to $75 a piece, right? All you need is for the bullish to be worth anything. And at that point, you're going to add to your profit, your net profit, because if you get out, let's say at you put a target of $25. You've exited your bearish. You now put a target of getting out of the bullish at $25, because it will have tanked. If you're able to get out of this, this might be worth $10, right? And you can go ahead and get out of that at that point, and you can take a basically a $30 profit on the trade, because you're in two of these. And so you'd have $20 there, and you would have made the credit of 10 in addition to that. All right. If this is worthless, you make $10. If you can make $10 a piece in addition to that, you make $30 on the trade. So even if it tanks, you're often able to take like a $30, usually a $30 target. But what I would do is I would actually put in a little bit bigger target. If the market bounces, you might see this pop up 25, and at that point you now have a $60 profit on that. So if it goes down, you want to get rid of the bearish if that's available. If it goes up, you want to get rid of the bullish if that's available as it's going through this profit zone. Now, if it goes through the profit zone too soon, so let's say it gets to 334. This is exactly what happened last week. And so I'll tell you exactly what I did with it. I think it was Wednesday that the market reached 334. And maybe on Tuesday. But at that point, I really didn't have a significant gain on the bullish, enough to offset my total risk on the bearish. And I knew that I was only at the beginning of my major profit zone. And so I decided to hold it a little bit longer, because I knew as time went by and the market moved up, if the market moved up a little bit more, I would probably be able to get out at a pretty significant gain with this particular with the bullish. And so it hovered around here for several days, and then on the last day it was moving back and forth. And so I put in a target on the last day of my bullish. The target was filled, and then what I did was I put on a better price for my bearish, and my target was for more than the maximum risk on my bearish. So in other words, if my target is hit, then no matter what, if the market continues to skyrocket, I cannot lose money on the trade, because my profit from my bullish already taken is more than my loss from my bearish. All right, so this is what happened. On the last day, I put in a target of 275. Okay, I got in at a debit of 75, and I put in a target of 275 each, and that was filled. That was filled, I want to say, around 336, when the market was trading at around 336, and that was in the morning. And my my spread for my bearish was at a 470. At the time that my bullish was filled, my spread on my bearish was at 470. Now, this is where understanding how the pattern works is going to help. This is why I say you need to start small. You can't just put on a bunch of these trades without understanding how these work. As I say, you start with one and you take a small target. and then you watch the trade, right? You watch the trade until the end. Even though you're out of it, now you watch it. You watch it like a hawk, and you're going to learn how it works, how the prices work with in conjunction with market movement. And then you take the next trade and you exit it at a target if it's available, and then you watch it after you're done, right? And so um, one of the things that you need to understand is that this spread cannot go to more than $5. Period. End of story. It cannot go to more than $5. Right. So I got in at a credit of 160 and it dropped down to a credit of 470, and it cannot go to more than negative a credit of $5. All right. So because of that, I knew I could only lose another $30 on this trade. And so what I did was I said, okay, if the market moves down at all during the day, then maybe I can add another $30 to the trade. And the market would have had to continue moving up pretty significantly for that 470 to go to $5 or 495, because what has to happen is it has to move so far up that there is no extrinsic value, there's no time value in this 331 call, even though there is still time left. It has to go so far up that it essentially renders it an impossibility for the market to come down to 331 by the close of Monday, which is, of course, ridiculous. It's not going to do that in most scenarios. So there was still a little bit of extrinsic value in these long calls. And so what happened was I get out of these targets, and it matters not now what happens, because I will have I locked in a profit on this trade no matter what happens. And in fact, I locked in a $60 profit on the trade no matter what happens. Okay, so here is what actually did happen. So here again, this is a 5-minute bar on the last day of the trade. And again, the reason that I held on is because when the market was trading at around 334, I knew that a little bit more time, I would have a little bit bigger profit. So the first day, because there's still 3 or 4 days left on the trade, the first day it hit 334, I think I was making maybe $120, $125 per option on the bullish, which is not bad, because still the maximum risk on here is not too much more than that. But if the market tanked, I didn't want to put myself at a debit. So in any case, this is what the market is doing. This is 336 down here, right? And this is 337. So it was in a range, it was in a very tight range, kind of like it's been doing today. It's been in a very tight range between 338 and 339. And then finally, towards the end of the day, the market comes down a little bit, hits 336. Well, my bullish was filled around here earlier in the day. And so once that was filled, then I placed my target in for 440. And eventually the market dropped below 336 at the end of the day, and a little bit of time value came back into the 331s, and I was able to exit at a 440 profit. It was somewhere around here, and then right before the market closed, it shot up, but I was already filled. So net profit on the trade was $120, and that's how it works out. This is a higher profit average than what is normally going to be expected, because in order to get into this $120 range, you're going to have to be in this bullish area towards the end of the trade, and that's generally not going to happen. Generally, you're going to be somewhere in here, or maybe you will have taken a profit on this and the market continues to move up, and if the market continues to move up, maybe it only makes $70, $75. But if the market is lower, by the way, if the market is trading lower, let's say around 300, 305, 310, somewhere around there, volatility is going to infuse back into these options. Extrinsic value will be infused back into the options, and the average profit will be bigger. While we're trading at these new highs, the average profit is going to be smaller, which is why it's even more critical that you understand how these work, so you don't make a mistake in how you exit the trade. So that was the trade over the course of about a 2.5-week period, where I placed it on well in advance, let it set, started looking at potentially exiting as early as Tuesday before the Friday, but decided to hold off on that, and finally put the target in at 275. And the question always comes up, how do you know where to put the target in at? And the answer is you can't go wrong by putting a target in at at what your risk is on the bearish for the bullish. Okay, you can't go wrong doing that. Worst case scenario, you end up breaking even on the trade if the market continues moving higher. So in this scenario, it was like 245. You put a target at 245, and you can't go wrong. If I would have done that, I would have made $60 on the trade. Okay, so and I would have had no risk, no matter what. Would have had no risk. Period. End of story. That's it. Right. So you can't go wrong doing that. So that's your minimum. It depends on when it reaches that 245. So if it reaches that 245, let's say you're not even into the profit zone, then that's a pretty good sign that there's more profit to be had. If you're in the profit zone and you're at like 225, then I would probably stick my target at 245 and be done with it. But on the last day, as we're going here, we're actually trading above the profit zone, and it was trading at around 250. And so I said if it moves back down into the higher part of the profit zone, it should easily hit 275. And that's what I did. Again, that's where experience comes in. The more you watch these, the more you're going to understand how to maximize the potential that is behind them. And so, that's how my decision was made. Okay. And again, sure enough, when the market was trading, and it may have been in this area that it was actually filled. When the market was trading around here, 337-ish, maybe a little bit higher than 337, that's when it was trading at around a 250. And I was not concerned about the market continuing to move higher. There was that part of the play into this because the market just made a massive move over a 2-week period of about 5%. And so I was going to play the probability on the last day that it wasn't going to continue moving higher, and that we would probably see the market move back into that into the major profit zone. At which point, I could potentially play the market going back and forth, and that's exactly what happened. Okay, so that was the trade. Now let's get to this week's trade, and I'll show you what I did this week in putting these closer together and structuring this closer together. And I'll show you a situation here that kind of shows where we're at. So this is the trade. I got in at the bearish at 122. I got in the bullish at 60. It gives me a total credit of 2 cents. So not a huge credit, but this is the trade. Let me pull this here, and I'll show you where it's at right now. Whoops. Let me do this. It'll be easier to do that. All right, so here's the trade. Here's the bearish. Here's the bullish. You'll notice that my strike on the bearish is at 338, and we're at 338.32. So we're almost right there at the low point of the bearish. But look at this spread. It's still trading at a credit of 57 cents. And you know why? Because of this 338 call here being the last day, it's maintaining. It's worth 84 cents. And so there is 50 cents of extrinsic value in this 138 that will leave by the end of the day. If the market stays here, it will leave by the end of the day. All right, so this is the trade, 338, 341, 342. That's my bearish. My bullish is a 343, 345, 343. So it's the same thing. The only difference is, look how close my strikes are. 343 versus a 341. It's 2 points instead of 4 points. That's what I mean by bringing the strikes closer on this trade. So let me pull in. This is where the trade was at yesterday. Okay, so right now this trade, because they've absolutely tanked the volatility in Monday options, this trade, look at my bullish. I was filled at 60 cents. My bullish is only worth, it says 11 cents. It's actually about 14 cents, which means that I have a total debit of 30 cents. And my here is 60 cents, which means I have an open position loss of $30 on this trade as of right now. But it's not a real loss, and that's because the market is trading at 338.29, and there's 82 cents of value on this 338 call. So this is how I know that I'm being forced to hold on to this trade. And there is some risk by holding on to it. By the end of the trade, I'll probably make a few dollars. I'm not going to make a whole lot on this, but I'll probably make a few dollars by the end of the day, unless the market moves higher. Okay, so why won't this move here? So I'm going to do this. Nope, that didn't work. It is stuck. It won't move, so I'm trying to get it moved. There we go. All right, so I was filled at $1.22 and 60 cents. And so now we're trading at 60-cent credit, actually a little bit less than that. And my bullish is trading at basically 14 cents. So almost 30 cents there. So again, losing 60 cents. Here is where the trade was at yesterday. And again, the market being right at this short strike of 338. This is a scenario where, based on the high volatility, even though I got the strikes so much closer, or the low volatility, I should say, even though I got the strikes closer, able to get strikes closer and got a better price because I still was able to get a 2-cent credit. This, the absolute collapse in the value of the long calls is something where you may want to take this trade. If you're new to this, you may want to take this trade and take your break even and move on. Now, having said that, let me show you the risk graph with this. Okay. Here is the dead zone. This is the dead zone that I'm talking about. When the market moves down, moves up, they collapse the volatility. It's basically, whatever you can get for the longs. is what's going to depend on this. And right now, the 343 longs. So I've got, here are my longs, the 342 and the 343. They're worth, as of yesterday, they're worth very little. As of today, those longs are worth 7 cents and 14 cents. 7 cents and 14 cents. And so now the market's actually moving down a bit. We're actually at 338, and my credit is at 48 cents, and my total debit on the other is at 22 cents. So they are moving that down. Nonetheless, this we're trading at 338, and this long is 5 points away, and it's only worth 7 cents, which tells you that they don't expect the market to go up 5 points by Monday, right? So it's very, very the farther it goes up, the more there is a buffer on it continuing to go up, which is why they take the volatility out of this. This is not the same as an individual stock. If you've heard me talk about volatility, they do not treat volatility in SPY the same way that they treat it in individual stocks, or QQQ or IWM for that matter. Any stock index will have volatility that drops out no matter what as the market moves higher, as long as there's not some sort of weird scenario that announcement that the market is waiting for. That's the only caveat there. So for example, if the Fed chair is going to decide whether to lower and increase interest rates, and they're waiting for that announcement, you'll see the volatility remain high up until that announcement. And then once that announcement occurs, no matter what, volatility will drop out of that. Even if the market moves down, volatility will drop out of that. And if it moves up, it'll especially drop out of it immediately. And so the further it moves up, the more they're going to drop the volatility out of this thing. And that's where you run into the issue of trying to get some sort of value out of these long calls. So the risk in this, by not getting out, if this is the scenario yesterday, and we're trading right at the short strike, and we're not able to get a profit on this trade, or at least not a very big one, it's not necessarily a wrong thing to get out at a break even. Now, if I'm losing, that's a whole nother story. Because if the market comes down, there's just a ton of extrinsic value that still has to be exited here. But if the market comes down, I'm not going to get anything out of the bullish, and so that'll be worthless. And I'll get the maximum credit out of the bearish, but that's still $10 at that point. So the opportunity never arose during the life of this trade because the market basically died this week right at these levels. The opportunity never came for me to really exit this trade at any significant profit, which is it's not disappointing from that standpoint, but it is what it is. But that, again, that kind of shows you the risk in this, in that the probability is that you're going to have many opportunities. You'll have signs to say, that kind of give you a clue as to whether you want to go ahead and get out of a trade or not. And then just kind of hit the reset button. So I purposely didn't get out of this trade at a break even yesterday, because I still am playing the reversion to the means, and I felt like I could probably get at least a $20 target out of this if the market moved down a little bit, and if the market moved up a little bit, I could probably still get out at a break even by the end of today. So the risk on this trade, though, is that if the market moves more than a little bit higher, to around 339, which it flirted with earlier today, 339, 339.50, which is right in the middle of this dead zone, they're not going to infuse any extrinsic value into the 343 or the 342 calls if the market moves up, another point and a half. And so there is a little bit of risk if they do run this market back up to the 339 area, which again was the old all-time highs, and they close it there today, then I'll probably lose a little bit on this trade, yeah, depending on exactly what the bullish is worth. Bullish might be worth. I'll probably lose around $30 or $40 on the trade if they move the market back higher. If the market remains fairly close here, I should make a few dollars. But the best bet on these, if you get to Thursday afternoon and you're right at this short strike, and you're not making money because they've cratered the volatility and they've cratered the value of the longs, then take your break even and move on. And that's how you keep your losses to a minimum on this. That's how you keep it at the 98%. You hold on to the last day, and if you hold on to the last day and you're in the middle of the dead zone, then all of a sudden, if they really tank it more, then you could end up, taking a loss in this small area. And then it's not, the lower volatility decreases the overall probability based on holding to the last day, but holding to the last day into the last minute almost always decreases the probability by a little bit, just because of that scenario. All right, so generally I avoid holding on to these until the last day at almost all costs. I didn't do that today for the sake of you guys and just kind of showing how this works. Now, again, with any trade, you have to be willing to take the max risk of the max projected risk of $100. And even though the probability of that $100 risk is very, very, very small, it is nonetheless what you have to prepare for. Okay. So that moves us into the current trade or the current possible trade. So this is what I had working yesterday, and I'll just move this into view. And I'll move this up. There we go. So this is what I had working yesterday. I have a lot of different trades that I look at. A lot of different combinations that I look at. But this is order, and let me see here. I'll make this where it's a little more visible. Whoops, not that one. Well, maybe I will. Hang on. All right. So here you can see order one, order three. I said I was going to place order three at a credit of 125. So what is order three? Order three is the 340, 343, 344. That is my TPO bearish one. That is out of the money, and it's out of the money by about 2 points right now with the market trading around 338.20. And I am actually willing and actually have a trade that is actually at the money, actually a little bit in the money. But to keep it a little safer, a little bit higher probability, I put this one in at a credit of 124, and I did this yesterday afternoon. And so what I decided that I was going to do was I was going to put that trade in, then I was going to put my bullish in at a debit of 60. And what is my bullish? That is order 4. That is the 345, 347, 345. So it's exactly the same thing that I did this week. The only difference, well, actually, there is no difference. It's exactly the same thing that I did this week. And pulling in a credit of, let's see, 60, 125, so a credit of 5 cents as opposed to a credit of 2 cents. And this was not filled yesterday afternoon, even though the market did move up a little bit more towards the afternoon, then it came back down. But as it was moving up, it didn't quite reach, this bearish did not quite reach a $1.25 credit. Now, with this, at the time, the bullish was trading at around 70, and I put the order in 60. So this is one reason I went with an out-of-the-money bearish spread. So this would be bearish neutral, because the break-even point on this spread would be somewhere between 342 and 343, most likely, depending on how much value is on the longs, if you were to hold on until the last second. So the market would have to make, another 5-point move to the upside by next Friday to get into the risk part of this trade. And so I am willing to get filled on the bearish and then wait for the bullish in these current market conditions, because the bullish is going to be a time suck. In other words, they will lose value if the market goes nowhere. If the market even moves up, they will lose value. And so because of that, you actually have a pretty high probability in scenarios where the market is, moving up so high that that they're killing the volatility, and the probability of the market moving up back up to around 343 in a short period of time is really relatively low. It's not impossible. You can't ever say that's impossible, but it is relatively low, and that is disguised by the value of these options. So what am I doing right now? These are. So I would be willing to get into this, at current levels, credit of 103, 104, 105, and then just wait for the bullish to get down to 50 cents. But the one caveat is that I am still in the trade today. And so if I'm in the trade today and the market moves up to let's say 339.50, 340, and I lose a little bit of money on today's trade, then I will also be closer to the risk level on this trade. And so for me, if I'm in a trade and I'm kind of teetering, on whether I'm going to lose a little bit on the trade or make a little bit on the trade, I'm going to wait, because if I end up losing a little bit of trade, that means that I will have gotten a better price on the new trade. And so I will wait on this one. And, it may be that the market tanks before the end of the day, and it may be that the market stays here, it moves up. But I will, I will look at what is available based on that towards the end of the day. Now, if I had already gotten out of the trade that I'm currently in, let's say yesterday at a break even, I would have gone ahead and gotten into this trade and then just let it sit. Okay. Now, the problem with this current situation is that the target scenario is a little bit less likely because of how far away the bullish is. And the market would have to move. So my order for my bullish, the market to go into the profit zone would have to move up to 345 to 347. And we're trading at 338 right now. Actually, we just dropped below 338. And that would be a 7-point move by the end of next week after we've already made a 5% move higher over the last 2.5 to 3 weeks. So that's the scenario. That's why I absolutely will have a credit, and no matter what. And I am more than willing to wait for the bullish to get a better price, because time will drop that the bullish option. The risk is, again, if you get into the bearish, as you can see, we're dropping in price right now. If you get into the bearish and your bullish is not filled and the market skyrockets, then technically you're at risk for whatever risk is on the bearish. Okay. So what I'm going to do is I will send out a signal towards the end of the day, and it may or may not get filled towards the end of the day. It'll be through Trade Partner. So if you've not opened your free Trade Partner account, I would do that so you can receive the signals and see exactly what I'm doing and how I'm doing it. If you would like Trade Partner to take the trade for you in your account, then you have to have an account at Tradier Brokerage, or TD Ameritrade. And TD Ameritrade, we just released the Trade Partner version on TD Ameritrade to a small group of beta traders, beta testers, and so that will be available with TD Ameritrade as well. All right. So that's what I'm looking at. I may make a few changes to that, depending on where the market is at towards the end of the day, and then we'll go from there. All right. All righty. So let's go ahead and take questions. Let's see. Joe, so it depends on the structure, and in current volatility, it does make it a little bit harder to take the profit target, or for the profit target to be hit by Thursday. If the market has died and is just sitting, kind of where your short strikes are on the bearish, and so it's just one of those things where the profit potential on that trade may not be very high. The structure is really important, though. As volatility is moving higher, again, you got to move those structures closer. Let's see, 98% report has a different bullish. So yeah, you can use, again, there's 4 different bullish trades that you can use. And the one that I've found that holds its value the best, even though right now this is not holding its value very well at all, it is still a little bit better than the others, and that is the structure of the the structure of the short strike being 2 points apart, excuse me, and the long strike being the same as the lower short strike. Okay. Yes, this was recorded and will be available shortly after. Let's see here. Let's see. So the bearish has 2 longs, and the bullish has 4 longs, because I'm doing 2 of those. In other bullish patterns, it might only be 2 longs. So that's certainly possible. It just kind of depends on which pattern you're using. So you've been shown basically 2 patterns. between these. All right, let's see here. Is it possible to lose more than the $100 in the dead zone? Yes, it is possible. A series of perfect circumstances has to occur for that to happen, but it is possible. Obviously, it is still limited, but it is possible. Where do you get the report? The report, you should have been sent an email on the report. Interactive Brokers is not available with Trade Partner. It is on the list, but Interactive Brokers still charges a commission, and they make it the most difficult to hook up to their platform. So it is coming, but I can't really give you a date. All right. Excellent. All right. Looks like I've gotten all of the questions, and I will see you in the next call. And again, take a watch for the signal later today, and it will have some exit instructions with it as well. All right, everyone, have a wonderful day. If you did not receive the report, contact support.